Welcome to the deep dive. Today we are cutting through a stack of pretty specialized sources to get right to the heart of financial security.
hmm
I mean, the goal for most of us is, it's universal. We work, we earn, we provide for our families, and we try to build some savings.
The rainy day fund, the retirement nest egg.
Exactly.
And if you look at the greatest, probably the most volatile threat to that entire structure, it's always healthcare costs.
Always.
We're talking about unpredictable, often significant expenses. Prescription drugs, specialist services, critical dental work.
Or sudden emergency care.
Right. And these expenses, they don't just, reduce your cash flow. They have the power to instantly wipe out years of careful saving.
Okay, so let's unpack this. This is about a critical defensive measure. Our mission for this deep dive is to really understand extended health insurance.
Yeah.
This is the tool, the mechanism, that's specifically designed to absorb those costs, relieve that financial stress, and, keep your main savings goals intact.
It's your financial shield, really.
It is. And we've synthesized the knowledge around the two most common ways to get it. First, group extended health insurance.
The one most of us get through work.
Right. And second, individual extended health insurance, the customized route. And that category also includes the notoriously tricky travel insurance policies.
And understanding the differences in how these two are built, and this is crucial, how they underwrite risk is, well, it's essential for every consumer. You need to know how strong that shield really is.
Let's start with group coverage then, because this is how most people, outside of basic provincial health programs, get their extended benefits.
It's the standard. Group plans are typically provided by an employer or maybe a professional association, any collection of individuals who share a common factor, like an occupation.
And the insurer offers a kind of package deal of benefits.
Exactly. It's often mandatory or at least highly standardized, which helps keep the premiums pretty stable for the entire group.
The convenience is obvious. You just sign up, often with very few medical questions, and you're covered. But what are the drawbacks of that mandated package approach, especially when you compare it to buying your own coverage?
Well, the main drawback is a complete lack of choice and portability.
Portability.
You're enrolled in a preset selection of coverages, and the moment you leave that employer or that association, the coverage ends. Often, like immediately.
Wow.
That lack of portability is a massive gap, especially if you're, changing jobs or thinking about retiring early. So the ease of access comes at the cost of control.
And that's where the individual option starts to look a lot more attractive. Individual extended health insurance is purchased directly from a broker or a representative.
Yeah.
You, the applicant, you own the policy and you control the contract.
And that control is the crucial distinction. Unlike the group plan, which is sort of a one-size-fits-all package, the individual contract lets you specifically pick and choose the types and levels of coverage you need.
Okay, so you can really tailor it.
Completely. You select your deductible, your coinsurance percentages, your annual maximums, all to align precisely with your budget and what you think you'll need.
So let's say your spouse has fantastic dental coverage through their work, but you have ongoing prescription drug needs.
Right.
You could customize your individual plan to focus heavily on drug benefits and maybe just skip the expensive dental riders altogether.
Precisely. You can use that individual plan to fill the gaps in your provincial plan, to strategically enhance a group plan you already have, or, and this is critical, to stand alone if you're self-employed or without any group access at all.
Oh, but there has to be a catch. There's a gatekeeping mechanism here that we should probably acknowledge up front. What's the major difference in the process of getting individual coverage versus group?
The big difference is the timing of the risk assessment. It's all about when they look at your health.
Okay.
For traditional individual policies, the insurer performs full medical underwriting prior to issue.
Before you're approved.
Exactly. They assess your entire health history before they agree to the contract. This way, they know exactly what risk they're taking on. It's a secure promise. However, and as we're going to discuss later, the exception to this rule travel insurance is where a lot of people find themselves in major financial danger.
Okay, let's circle back to that danger. But first, let's talk about the mechanics that govern almost every health plan, group or individual, deductibles and coinsurance.
Right.
These concepts seem simple, but they are absolutely key to managing your out-of-pocket costs.
They are. And these two provisions are designed by the insurance industry to do two main things. First, they manage the financial burden by sharing it with you, the insured, which lets the insurer lower the overall premium.
That makes sense.
Second, And maybe more importantly, they discourage what the industry calls undiscerning use.
Undiscerning use.
It just means if you have some financial skin in the game, you're probably less likely to claim for non-essential services.
Got it. So let's break down the deductible. It's simply a dollar amount of qualifying expenses that you have to pay in full, 100%, each year before the plan starts paying you back for anything.
Yeah, a great illustration of this is Jose's dental plan. Let's say he has a $100 annual deductible for dental.
Okay.
He pays for the first $100 worth of cleanings or fillings himself. Only after he's met that $100 threshold does his insurance plan start to pay its share.
It's interesting, though, that deductibles are pretty rare in core individual medical contracts, but they are extremely common in dental coverage. Why the difference?
It really comes down to frequency. Dental maintenance is highly predictable. It's frequent. You go twice a year for cleanings. If the insurer covered every single small expense 100% from day one, the administrative cost of just processing all those small, frequent claims would drive premiums sky high. The deductible helps manage that high frequency.
Okay, that makes perfect sense. Now let's move to the co-insurance factor. This is where you continue to share the cost with the insurer even after you've met the deductible.
Right. The coinsurance factor is just the percentage of a qualifying expense that the plan pays. You're responsible for the rest.
So if Consuela's policy has an 80% co-insurance factor for her prescription drugs,
Then the plan covers 80% of the cost, and Consuela is responsible for the remaining 20%.
that 20% might sound small on its own, but when you think about high-cost maintenance prescriptions or extensive dental work that starts hitting your annual maximums, that remaining percentage really adds up fast.
Oh, absolutely.
Yeah.
It's crucial for people who are managing chronic conditions to understand their total out-of-pocket exposure.
And speaking of dental, let's dig into why that coverage is such a mainstay of these extended plans.
Well, it's simple. It's because provincial public healthcare plans offer very little, sometimes nothing, for routine dental fees and major appliances.
So the financial responsibility for just maintaining your teeth falls almost entirely to you and your insurer.
It does, and benefits are usually divided into levels. The first is routine maintenance. That's your checkups, x-rays, cleaning, fillings, simple extractions.
Basics.
The basics. These are usually covered up to an annual maximum, say $1,000 to $1,500, and are subject to that basic co-insurance, where you, the insured, typically pay 20 to 25%.
But then you have major restorative services, things like crowns, bridges, and inlays, which are expensive.
Very.
And these services, they typically come with a significantly lower co-insurance factor. Why does it dip to, say, 50% coverage?
It's another utilization control mechanism. These services are often discretionary and they're very costly. By making the insured responsible for half the cost, the insurer makes sure the patient seriously considers alternatives and the necessity of the work. It, again, helps control premium inflation for everyone.
Now, here's a detail that always trips people up: the fee restriction. Insurers don't just pay 80% of whatever your dentist charges, do they?
No, absolutely not. This is so important. Coverage amounts are strictly restricted to a fee schedule set by the provincial dental associations.
Okay.
If a dentist charges more than that provincial schedule allows, the excess amount is entirely your responsibility. It is not eligible for reimbursement.
That is a critical detail. Let's look at Igor's situation from the source material. His extraction costs $300, but the scheduled maximum amount allowed by the provincial association is only $225.
Right. So first, Igor pays the $75 difference that the plan won't even look at.
Out of pocket, gone.
Gone. Plus, he then pays his coinsurance percentage on the remaining $225 covered amount. His total out-of-pocket cost is compounded by that schedule restriction.
So you really need to know that fee guide.
You do. This is why for extensive work, often $500 or more, insurers strongly suggest a predetermination. Get an estimate submitted to confirm your coverage limits before the procedure begins. Never, ever skip that step.
Okay, moving beyond dental. Individual medical policies are really designed to be gap fillers. For long-term Canadian residents, that means filling in those provincial blanks for things like prescription drugs, vision care, chiropractic services, and hospital stays in a semi-private room.
It also often includes what the industry calls AD&D coverage. That's accidental death and dismemberment.
Right.
It's a lump sum benefit that's paid out if the insured dies or loses a limb or their sight because of an accident. It's meant to supplement standard life insurance in case of a catastrophic injury.
And crucially, For new arrivals to the country, individual medical insurance is a critical necessity. It provides cost protection during that mandatory provincial waiting period before they can qualify for public coverage.
You cannot afford to go without coverage during that transition. It's just too risky.
Okay, now let's pivot to this segment that I think represents the most catastrophic financial risk to the average traveler.
Emergency medical travel insurance.
The cost of a medical emergency outside your home province, especially in the U.S., it's astronomical.
Truly.
So travel insurance is this umbrella term for the protection you need. Emergency medical, trip cancellation, repatriation, and it's widely available everywhere. Insurers, travel agents, financial institutions.
But that convenience is a veneer. It's a mask. The core vulnerability is this. For nearly all issuers, medical underwriting is generally done retroactively.
What does that mean exactly?
It means it's done at the time of claim, not when the policy is issued. They take your money up front, and only when you're in a hospital bed do they decide if they will actually pay.
That is the single most terrifying piece of information in this entire deep dive.
It's a huge problem.
You purchase the policy believing you're covered, but the actual decision on coverage is made when you are at your absolute most vulnerable.
And this is the origin of what we call the pre-existing condition trap.
Which is the #1 reason claims get denied.
It is, and the rules are incredibly strict. You have to demonstrate a period of medical stability. Generally, if within, say, 90 to 180 days before you leave, you saw a doctor for symptoms, you underwent tests, were recommended tests, had treatment, or even had a prescription dose change.
Even for something minor.
Even for something perceived as benign, like a daily baby aspirin. If that happens, that condition can be deemed unstable and therefore pre-existing.
So if I went to the doctor 3 months ago complaining of a persistent cough, and then a week before my trip, that cough flares up and lands me in a foreign hospital, they can use that 3-month-old visit to deny the claim.
If the insurer determines that the flare-up is directly related to that initial symptom, yes, they absolutely can.
Wow.
And even chronic conditions diagnosed years ago, like diabetes or hypertension, may restrict coverage if you haven't been symptom-free and under stable physician management for up to a full year prior to departure. The onus is entirely on you to ensure that stability period is met.
But, and this is an important clarification, the existence of that pre-existing condition doesn't invalidate the entire policy, does it?
No, it only denies claims related to that specific unstable condition. The example of Antonio from the source is perfect here.
Okay, right. He's traveling to Italy and manages his epilepsy with daily medication.
So if he suffers an epileptic seizure in Italy, the medical expenses for that will be denied because the claim is related to his unstable pre-existing condition.
However, if Antonio's crossing the street in Rome and gets hit by a bicycle, requiring surgery for a broken leg,
those medical expenses would be covered because the injury is completely unrelated to his epilepsy. The policy is still a crucial safety net for any unrelated emergencies.
the policy requirements are demanding, though, especially during a crisis.
They are. Payment is often reimbursement-based, which means you or your family might have to pay these massive hospital bills up front and then file for reimbursement later.
And you have to contact the insurer immediately, right away, upon hospital admittance or before any major surgery. Why is that contact so critical?
Yeah, because the insurer needs to take over case management. They need to guarantee the costs are reasonable. If you fail to contact them promptly, they can later claim the costs were excessive or the treatment was unnecessary, and they can potentially reduce your benefits or deny the claim altogether. It is a non-negotiable step in an emergency.
And beyond pre-existing conditions, there are other standard exclusions specific to travel policies.
Yes. You won't be covered if you engage in inherently hazardous activities, things like hang gliding or uncertified scuba diving. You're also not covered if you travel to destinations on a government watch list because of war or political instability.
And it's for emergencies only.
Right. You must not seek treatment for non-emergency situations. Travel insurance is for the sudden and the unexpected.
Let's talk about the cost of this protection. We know the key premium factors are the amount of coverage and the length of the trip, but destination makes a huge difference too.
Destination risk dramatically affects the premium. Travel within Canada is low, but travel outside Canada sees a major spike. The largest spike is always associated with travel to the U.S., where hospitalization and specialist fees are exponentially higher than anywhere else in the world. It just dramatically increases the insurer's potential payout risks.
Yeah, and the other overwhelming factor influencing the price is, of course, age. How drastic is that difference?
Age is the single biggest determinant of cost, especially once an individual passes 60 or 65. The actuarial risk of illness or injury just increases rapidly. We saw this so clearly in the source material. Trent, who is 60, paid $719 for a 21-day deluxe travel package. His associate, Quince, who's 40, purchased the identical plan for $570.28.
Wow. That's a 25% difference.
And that difference is purely a measure of increased age-related risk.
That is a hefty surcharge just for being 20 years older. Okay, one last financial detail. The tax treatment of these premiums.
Premiums for individual extended health coverage are not typically income tax deductible on their own, but they may contribute toward the federal medical expense tax credit threshold.
Oh, okay.
And crucially, any benefits you receive, whether for drugs, dental, or emergency medical, are received as tax-free income.
So what does this all mean for you, the listener, the traveler, the saver?
The core lesson here, I think, is that extended health insurance is not a passive purchase. You have to actively manage it. You need to understand your deductibles and your co-insurance exposure. And you must meticulously vet the fine print on medical stability, particularly before you step onto a plane. You just cannot outsource your own personal risk assessment.
Which brings us back to the most critical takeaway from this entire deep dive, the peril of retroactive underwriting.
Absolutely.
You have to ensure that your medical eligibility is secure before you depart. If you rely on that automatic credit card coverage or an off-the-shelf policy, you must rigorously review your medical history against that stability clause to avoid the potential for a claim denial in a foreign country. Uncertainty is the most expensive thing you can buy.
That's the strategic point. We've seen that deductibles and coinsurance are really mechanisms of transparency. They're designed to incentivize smarter use and manage the insurer's risk.
And this raises a provocative thought for you to carry forward. If ensuring medical stability and upfront cost sharing are the only ways to manage the tremendous volatility of health risk, how can you apply that same lesson to your personal savings and investment strategies? Rather than just chasing returns, how can you build stability and transparency into your own portfolio to proactively underwrite your own financial risk against market volatility or unexpected life events, ensuring you have clear, predetermined outcomes for your most critical goals?